It's going to be a huge recession. I think it'll be a bigger recession, a deeper recession than anything we've experienced in our lifetime. And so this could be one hell of a hangover. I think unlike previous recessions, this one is going to be inflationary. You're going to have recession and inflation happening at the same time. And that's what's going to make this recession so much more painful, because even if you don't lose your job, it's going to hurt.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar. Before listening to him, please ensure to smash the like button and subscribe to the channel.
What is going on, and is the Fed winning, or are there actually problems underneath all of these seemingly positive numbers?
No, the Fed is not winning, but everybody else is losing, that's for sure. They haven't really destroyed demand. They've changed it a little bit. But if you look at what's happening, people who have jobs are spending everything they earn, and then some. The savings rate is near record low. Credit card debt is record high. So people keep on spending. Nobody is cutting back on their consumption. Maybe they're spending more money on food and insurance and rent and less money on other items. But in aggregate, we haven't seen a reduction in spending or an increase in savings. The government continues to spend like crazy. They just passed that reconciliation bill. But the government deficits, despite what Biden said in his non-State of the Union address the other night, the deficits are skyrocketing. And so that's all additional spending, demand in the economy. The Fed hasn't done anything to bend that curve. And so I think we have seen this transitory improvement in the numbers because they were really bad and now they're not as bad. But I think that as the year progresses, we're going to see that change, and we're going to start to see a worsening of the inflation data again, something that the markets are really not prepared for, neither is the Fed.
Why do you think it is going to get worse? And this would contradict, there's many investors like Barry Sternlicht and others who think that we're actually going to see negative inflation come the summer. What is your logic in terms of why you think the inflation data will worsen over the coming months?
Yeah, well, first of all, it's only 7% if you look back for an entire year. A lot of people are saying, hey, if you look back 6 months, it's around 3 or something like that, which may be true. But of course, again, the way the government measures prices and what actually happens to prices are two different things. So the real increase in prices is much greater than what is being officially reported by the government. But I think that, you had this initial spike in a lot of prices, and then the Fed started hiking rates, and that had an impact on the dollar. It had an impact on commodities. You saw commodity prices come down, particularly oil prices, and higher interest rates had an impact in housing and other areas of the economy. And so you got some temporary easing of the inflationary pressures. Also, U.S. GDP got a boost from the strength of the dollar because the initial result of higher rates was a stronger dollar. That brought down the cost of our imports. That helped keep commodity prices down. That also helped boost the GDP numbers. But I think all that is going to reverse. We saw a big drop in the dollar in the fourth quarter. Dollar weakness is continuing so far in 2023. I expect it to accelerate. And that's going to worsen the trade deficits, and that's going to help push commodity prices to new highs. And all of that's going to put renewed upward pressure on the inflation numbers. Well, the real problem for the Fed might be that not only do we get a surprise uptick in inflation, but we get a downtick in the economy. It's only a matter of time before we start laying people off. I mean, we're already laying people off, but eventually it's going to be impacted more in the official numbers. Because right now, what's creating all this noise in the jobs numbers are all the part-time jobs that people are being forced to take on because they can't get by on the income from their full-time job. Or some people may have had a couple of part-time jobs and they needed to take a third part-time job. So that's going on right now, because if you look at the data over the last 10 months, we've actually lost full-time jobs. There are fewer people that have full-time jobs now than had them 10 months ago, but you have over 1.5 million more people that now have part-time jobs. Now, some of those people still have their full-time job. They're just working another job. Now, why would somebody who has a full-time job go out and get a second job? Well, it's because they can't afford to pay the bills with the salary from their full-time job, so they need to moonlight. And so that's what's going on, and that's really what is impacting these numbers. As far as why the unemployment number is so low, I know a lot of people aren't being counted as unemployed. And I know a lot of people a couple of years ago made the decision to be self-employed. You know, they got into the gig economy, whether they're driving Ubers or DoorDash or something like that. And so they can never be fired. You know, once you decide that you're just going to work for yourself, you can't fire yourself, so you can never really be unemployed. So I think there's a lot of noise in these numbers. I think the labor market is considerably weaker than the Fed believes or the market believes. But at some point, all these layoffs that we're getting, and look, more layoffs were announced today. Look at a firm that buy now, pay later companies, stock down 20% today, laying off, I forget, a quarter of their workforce. I mean, who didn't see that one coming? I talked about the nonsense of these buy now, pay later companies when they were, you know, all the rage. But one of the reasons that consumers were able to spend money is because they didn't have to pay. They just got stuff for free and they thought they'd pay later. But of course, they're going to pay never. And that's going to be the problem for a lot of these companies because, you know, they fronted the money and now they're not going to get it from their customers. But you're getting more and more layoffs, you know, from tech companies. You're going to see a lot more layoffs in, you know, crypto and blockchain. All these companies, you know, hired people. I mean, all these guys are going to lose their jobs. But I think that what's going to surprise the Fed is going to be that not only is inflation going to turn higher, but the economy is going to turn down, and so will job creation, and unemployment will go up. So inflation will be stronger than the Fed expects. The economy will be weaker. Now, what does it do? That's the $64 trillion question. Is the Fed in a weakening economy and maybe even a financial crisis? Who knows what might blow up? Because interest rates, you know, they're almost 5% now, and they're going to be 5% pretty soon. You know, we were at 0, so that's a huge change. You know, you built an economy around 0% rates. It can't function at 5%. The whole thing has to implode, which is a good thing because we had a phony economy, and that needs to implode. But when it does, it obviously creates a lot of problems. A lot of people are going to lose a lot of money, and that's not going to be something that the government is going to want to sit by and just, you know, watch it play out. They never do. They always feel compelled to intervene and do something, even if what they do makes everything worse. But will the Fed sit back, or will the Fed rather fight inflation and say, you know, to hell with the economy or the labor market or the financial system or the stock market? We don't care. We're going to fight inflation. We don't care what's happening in the economy. Or are they going to say, we don't care about inflation. We got to go help the economy. We got to do something about what's happening in the economy. And of course, the only thing the Fed can do is create inflation. That's the only thing it's ever done. That's its only tool is inflation. So the Fed is going to have to say, yes, we have high inflation, but we're going to make it even higher because we feel that we need to do that to help the economy or the labor market.
And so when you see what the Fed is doing, is there some weird world where like all of the effort and all of the time and energy that they're putting into draining liquidity is just being washed away by these Asian central banks that are actually pumping liquidity in at a much faster rate than it can be drained on the Western world?
Well, first of all, I don't know that the Fed is actually draining it fast enough. I mean, the balance sheet's still around $8.5 trillion, excuse me. So it's an enormous balance sheet. I mean, you know, it's only come down maybe $500 billion from its peak. But of course, the balance sheet blew up a lot faster than it's shrinking. Remember how quickly we inflated that balance sheet. The deflation is taking a lot longer. And I think it's going to be aborted. I don't think the Fed is going to continue on this path because the rate hikes that we've already had are taking a toll on the economy right now. And we're just beginning to see the effects, and it's going to get a lot worse. Remember, it's only been a year, not even, since the Fed raised rates for the first time, right? So, you know, there is a lag between the increase of rates and the effect on the economy. And so we're just kind of catching up to those effects, but they're going to be enormous in all segments of the economy. I mean, not just the stock market and the real estate market, but you have an American economy that's based on cheap money. I mean, that's what it was running on for more than a decade. Well, now it's time to pay the piper, and everybody's broke. You can't pay the piper. So that's bad news for the piper, who thought he was going to get paid, but it's everybody else too, because now they can't get any more free music or entertainment. So there's a huge day of reckoning here that we're just on the cusp of.
Let's take kind of each segment of the market or each market participant independently. What does this mean for small business owners or individual investors or consumers? Is there kind of a full-on recession? How bad is it? When does it happen? How are you thinking about what the impact of this situation will be on the average American or those small business owners?
Well, yeah, it's going to be a huge recession. I think it'll be a bigger recession, a deeper recession than anything we've experienced in our lifetimes. And, because a bust is proportionate to the boom. And this has really been an unprecedented boom created by the Fed, created by artificially low interest rates and quantitative easing. And so this could be one hell of a hangover. That's what's going to happen. And, but different people are going to be affected differently. The definition of a recession is when your neighbor is out of work, and it's a depression when you're out of work, right? So, not everybody's going to lose their job. But I think everybody's wages are going to be reduced in real terms. So even if you don't lose your job, I think that the money that you earn is not going to go as far when you go to buy stuff, because I think unlike previous recessions, this one is going to be inflationary. You're going to have recession and inflation happening at the same time. And that's what's going to make this recession so much more painful, because even if you don't lose your job, it's going to hurt. And I think most investors are going to lose money. I think most investors over the last decade or two have been channeled into the wrong assets by the artificially low interest rates. So a lot of people own very high multiple companies, growth companies, and in fact, companies in many cases that don't even have any earnings at all. Right? They were just speculating on earnings in the future. But people were willing to do that when the cost of money was basically zero. But I think as the dynamics change, a lot of people are going to realize that they're holding the wrong assets, and they're going to get repriced and marked down. So, there's going to be big losses for most investors that, have the FANG stocks or a lot of these stocks that did really well, when the Fed was blowing up the bubble, but they're going to do horribly when it bursts. And then, the same thing for, your favorite cryptocurrencies. I mean, cryptocurrencies also got caught up into the speculative mania. And, the air is going to come out of that bubble too. So a lot of people that had a lot of money, or at least they thought they had a lot of money in their digital wallets, are going to find out that there's really not much there. I mean, they'll still have the crypto. They just won't have much real money if they try to sell it.
When you look at the assets that will do best, so you talked about FANG stocks, crypto, a couple of other assets that you anticipate will do poorly in this environment. What are the assets that you're most excited about, or that you think the average individual likely will end up benefiting if they are positioned correctly?
Well, I mean, these are the assets that I've been buying for a long time, anticipating this. It's not like I just woke up and decided. I've been planning for this for a long, long time. In fact, a lot of people would say, well, see, I'm wrong because I've been saying this for so long. I wasn't wrong. I just knew what was going to happen a long time before it did. But I think the assets that are ultimately going to do well are, one, commodities. I think commodities are going to do extremely well in an inflationary cycle. And that's, all sorts of commodities, industrial metals, agricultural commodities, oil and gas. So I have investments there. And of course, precious metals, they're, going to do very well. Gold's the king of all commodities. And I think it's going to do very well in a commodity bull market, especially if we ultimately end up having a dollar crisis, currency crisis, and gold is, remonetized in some shape or form, either by the private sector or by various governments. And so there could be a huge increase in the price of gold in this type of environment. But I think that there'll be a lot of money lost in bonds, paper assets. I think that people that own quality real assets will do better. And so that's the value stocks. I mean, companies that actually have big earnings right now, not companies that might earn money in the future, but that earn a lot of money right now and have been earning a lot of money in the past, so that the income is reliable and dependable. And the companies are selling goods and services that people really need to buy. and they'll buy them. I mean, maybe they'll buy a little bit less, but they'll keep buying, and they'll cut back or give up something else in order to buy these things. And so you want to own those businesses. I think the businesses that cater to consumers that don't have a lot of debt and that have more productive jobs are going to be better because their customers are going to be in a better position to pay. And, so that would exclude, the U.S. I mean, some Americans will be able to pay, but a lot of Americans will be too broke to buy products. I think the emerging markets are going to be, much more fertile ground. I think the consumers there are going to be in better shape. They don't have the kind of debt that you have, let's say, in the United States or some of the, more developed Western economies. You have younger populations. They're still working, educated, skilled. Making stuff, and so they can, generate real demand because they could also generate supply to create that demand. And so, I also want to invest in those economies. I think emerging market stocks will be winners, in this environment. I think they'll do better on balance than the developed markets. And I think, overseas markets will do better than domestic markets here in the United States. And I think equities will do better than bonds, but it depends on the equity. I mean, because there are stocks that are going to go bankrupt, and that's, you lose 100% if your company goes bankrupt. But a lot of stocks that won't go bankrupt, investors will decide that maybe they're worth 10 cents on the dollar or 5 cents on the dollar relative to what they thought in a very different investing environment.